What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. As you can tell, I'm home again. Unfortunately, this time it's only for a night. I'm leaving again in the morning to go for work again. Um, so I just wanted to take this opportunity to, since I'm back for at least a night, to go over the recent blog post that I wrote over the my last kind of work, out of town work stint or whatever. This one was over LIBOR, and so we will do the screen share and get that pulled up for you guys. So basically, one of the things with LIBOR that for me has been interesting, at least, is so I've heard it talked about quite a few times, and that was one of those things I kind of just kept putting off. And every time I'd hear it in, say, like a podcast or read it somewhere, I'd be like, what is LIBOR? And, like, I kind of understood that it was an interest rate, but I wasn't really sure how it worked, so I decided to actually, grow a pair and do one and actually research it. And so I found and went through 5 or 6 different sources, from various entities and, wrote a post about it. So, aw, dang it, all my highlights are gone. I've never had that happen on my site. Okay, so we'll wing it. So basically what LIBOR is right here. So LIBOR LIBOR stands for the London Interbank Offered Rate, right? And it's a benchmark interest rate based off of interest rates at which certain banks can lend unsecured funds to one another on that particular day. And so like they are literally asked, and this was quoted from their survey, is at what rate could you borrow funds were you to do so by asking for and then accepting interbank offers in a reasonable market size just prior to 11 a.m. Um, right, and so they're literally asking, how much could you borrow, right? And it's changed a few times, like how they kind of worded the questions to. It's changed from like how much could you borrow to how much could you lend and so on, but it's pretty much always at this 11 a.m. on a business days because that's when it's published, right? And so one of the things that's kind of a that's happened with LIBOR is being kind of phased out. And we'll get a little bit more into that further into the video. Um, but one of the reasons why it's so important to begin with is that, and I was actually quite surprised when I read this part, um, that, it's incorporated in more than 300 trillion different financial contracts. And this includes like futures, variable rate mortgages, and student loans. And those are just examples. I have more throughout the post. And so these aren't just like major financial entity like contracts and stuff. So like it's not a problem for just like hedge funds or like sovereign wealth funds or whatever. It's like, your typical person can be directly influenced by LIBOR, right? Um so how is it calculated? So we know that there is this question posed to each of the banks. So how are they exactly supposed to decide, right? And so one of the more recent developments, recent being like the past decade or so, has been this waterfall method, right? And so essentially it's 3 tiers, and you start out with level one, which is transaction based. And so it takes was it a volume weighted average price, I believe is, yeah, volume weighted average price. So I want to get how they word it correctly. um, and those are only for eligible transactions, right? And those are weighted. Um, they're more heavily weighted the closer they're booked towards 11 a.m. London time. Because remember, all of this is based off of London time, because it's the London interbank offer rate, right? And so level one is kind of first priority, and they do it based off of the transactions. And then if there's not enough transaction data, they can go down to level two, which is transaction derived. Basically, they derive more data essentially from either throughout history or just adjusted. So this is time-weighted historical eligible transactions adjusted for market movements and linear interpolation, right? So essentially taking historical data and making it relevant to today, right? And if there's not enough of that, then they go down to level 3, which is expert judgment, right? And so that's pretty self-explanatory on what it is, and they have other stuff with how they have their own procedures, and there's a code of conduct and everything else, but expert judgment, right? And so you can kind of assume stuff from there. So there's those. And then one thing to note is this was an international kind of thing. It still is, I guess, in a way, but not to the same extent. So there were 5 different currencies that they were doing this for. So the US dollar, euro, Swiss franc, pound sterling, and Japanese yen. And they also did it for 7 different tenors. So kind of their duration, right? So overnight, 1 week, 1 month, 2 month, 3 months, 6 months, and 1 year, right? So this was 35 different rates. And basically all of the panel banks, because they would give this survey to certain panel banks, which is they're all listed here. Excuse me. And the dots represent which currencies that each one had to do all the rates for. So say Bank of America here would do the US dollar one, and they would do all tenors up for the US dollar. And then same thing with all the other ones. And so like the Royal Bank of Scotland would do all the currencies at all the tenors, right? Whenever they submit those to the ICE or ICE, which is kind of the I don't want to say committee, but kind of the oversight in a way. Um, Sorry, with the highlights gone, I'm I may have skipped a few things, just little facts or whatever. Um, Basically, like changing a transition for who, um, I don't want to say owned. Trying to think of the right word. Kind of who had oversight in a way, but anyways, more clarification on that later because I know I wrote about it later in the post. Um, Anyways, so the panel banks submit their submissions to the entity, and then from there they basically do something called the trimmed average, where they take the top and bottom quartiles and basically trim them off, and then they just average the middle two, and that's your daily LIBOR rate for whatever currency tenor pair that happens to be, right? Um, and so one thing to notice, I have said a few times already, eligible transactions, because this is for, or this market that LIBOR kind of prices, is for unsecured funding, right? Um, and so all of this is for different unsecured funding markets. And so that would include things like unsecured time deposits, commercial paper, or CDs, like certificates of deposits, right? And so another thing to keep in mind is there's also counterparties to those, and they have to be eligible as well. So examples of those would be like other banks, sovereign wealth funds, central banks, government entities, non-bank financial institutions, and some others. You can also find a lot more on that and like kind of more specifics on like who exactly is allowed and stuff like that in the USD LIBOR mythology paper, which of course is linked in the references at the bottom of the post. Um, I prefer because the whole point of these videos and the blog posts and everything else is to like get the information out, use all the sources, really try to understand this kind of stuff. Um, so the sources are always there. So yeah, and this was done by the IBA, which I think I misspoke earlier and said ICE. Um, no, there's a lot of acronyms. Sorry. And so one thing to notice is when we're looking at this waterfall mythology, right? And so like you can kind of tell there's different level. Obviously, there's just different levels to it, but like how is that weighted? Like how much of these are going to be level 1 submissions? How much are level 2 and how much are level 3? Well, they actually gave that in one of the papers. And here is an example of the USD one, so the United States dollar. And so the light blue are level 1 transactions. This kind of dark, I guess black, it's hard to tell. Yeah, black is in the middle are level 2, and then the topmost, the dark blue, are level 3 transactions. So the level 3 are the expert judgment transactions. And I picked the US dollar one because it's the reserve currency of the world, and two, it's also the one with the least amount of expert judgment. Um, so it could actually kind of show the different levels because some of them were essentially completely dark blue. So even though you had a waterfall mythology, um, they were still doing it primarily off of expert judgment. And some of that has to do with the nuances of like when certain currency tenor pairs um, stopped being submitted or reported, I guess I should say. And so there was kind of a phase of, I think it was 18 months, in where they tried out this waterfall mythology to see how it would work. So there's that. And so for some reason, this one highlight stayed. So I don't know. The one I didn't need naturally. Um, yeah, so for example, and then like I wrote in here, the Swiss franc was one of the ones that was almost essentially like it was almost exclusively level 3 submissions, at least during when they did this study. And looks like this is for the ICE LIBOR evolution paper, right, which is the Intercontinental Exchange. Um, so one reason for these types of for so little trans or submissions, right, based off of transactions is those transactions aren't there. There's not enough volume of those eligible transactions to do this, um, for whatever reason, right? And so a lot of that could do with basically the panel banks and just banks in general are not as incentivized to borrow in unsecured money markets anymore. And this is one concept that was explained pretty well in Joseph Wang's book, Central Banking 101, which I've done a video or two on it because it was very helpful in helping me kind of understand, um, at least from a grand scheme of things, how this stuff kind of works. This is definitely a book that, I mean, I'll be reading it multiple times. It doesn't go like it's not extremely nuanced and in-depth, but it's like if you don't understand, like, how all the little pieces of, say, the monetary system work together that seem to be unrelated, but they're really not, um, and you don't understand how those are kinda put together, like, it's very helpful in understanding that from more of a bird's eye view perspective. Um, and it's short, if you care about that. It's only, like, 200 some pages. But yeah. Okay. So what is LIBOR even used for? Obviously it's global in scope, how it used to have five different currencies in it, five major currencies in it. And those currencies also changed too, right? Because LIBOR was initially created, I guess, in the 1960s or the late 1960s. And so obviously you had changes in currencies. One of those, as an example, would be the consolidation of the euro. So like in one of the papers, they had a nice graph showing like the different rates for the different currencies that they had throughout the time periods. And you have a massive break in one, and then it pops up again wherever the euro started. And so they did keep track of all that kind of stuff too. A lot of the times for LIBOR itself, when you see it in financial contracts, it'll literally say like LIBOR plus X percent. And I put X because that's whatever percent premium that institution or whatever you're happy to sign the contract for, whatever it happens to be, that's kind of the spread to ensure they have a profit. And so this is where you see with like the variable rate mortgages, for example, if like say they go up 10% or 10, that's terrible terrible example. I don't know why that number just came out the top of my head. I'm sorry. But if they just like jump, say like 2% or whatever, um, then LIBOR, I'm sorry, if LIBOR jumps, say 2%, then that entire rate will get shifted up as well, is what I'm trying to say. Um, and this is again is for things like variable rate mortgages that are sometimes on them. Um, And so other examples that they had were government debt, corporate debt, some auto loans, student loans, and over half of the US flexible rate mortgages. And I cited that one so you can find exactly where it is. It's in citation 6. I just kind of want to point it out directly if I can, right there. So this one, as you can see, they're all links, so you guys can go to them easily. That's really what I want the whole point to be. See if I can find my place again. And so as you can tell, especially with, sorry, let me gather my thoughts. So essentially, with the waterfall mythology, if you kind of think about it, and you have level 3 submissions based off of expert judgment, a lot of people would assume that that goes straight, like there's moral hazard there, or the possibility for moral hazard and possible scandals as well, which has happened, unsurprisingly. Um, so, with that being said, there was one, I don't want to say one, it's probably multiple, but there's kind of a series, I guess one series, that they talked about exclusively in the publications. Basically, they did a series of international investigations about a decade or so ago that they found manipulations of this LIBOR rate were happening with some of the panel banks and possibly even as early as 2003. And so culprits on that list of banks or panel banks, I should say, that were manipulating LIBOR were like Deutsche Bank, Barclays, the Royal Bank of Scotland, and then others as well, right? Um, And so if you think about it, just think about like what LIBOR is. Like it's an offered rate, right? And so you have this kind of incentive to to influence in a certain direction. This is one of the things that I thought about for I, hmm, how to word it. I've given it some thought because it's one of those I don't want to just be like, yeah, they're manipulating it like crazy or whatever. But it's also like I mean, how many different panel banks are there? If I can get to the thing. So say for like the US dollar, you got say 12, 15-ish. I don't want to sit here and count them, but you got at least a dozen or so panel banks. And so like that means if you're um doing the trimmed average, you're having about 8, right? Somewhere in there. Rough numbers. That's the whole point. And so essentially when they would try to manipulate it down, I'm unsure on how much of an effect that have on the overall LIBOR rate because it is averaged with the 2 middle quartiles. And so it's like I even in one of the sources, and I forgot which one it came to mind and which bank it was specifically, but one of the banks was even talking whenever they got accused and I think proved that they were manipulating LIBOR, they were like, yeah, but it was something like the vast majority of the time they were in either the top or the bottom quartile. And so their offered rate wasn't even involved in the average for LIBOR anyway. So it didn't really make much of a difference. And that's one of the things that, you know, yes, it didn't have much of a difference, but it's still like this is a market that has this is an interest rate that has an estimated influence over, I think it was $800 trillion. Like there were multiple estimates, and I wrote it up here. Basically, it's incorporated in more than 300 trillion, sorry, in financial contracts, and then there's other sources that estimate closer to 800 trillion. So that's either way, it's a massive number. Um, and something to keep in mind. Like it's not a small ordeal for that to happen. And so like how big of a deal is that? Even if they were trimmed out of the average, does it really matter? It's kind of the mere fact that they were manipulating it to begin with. And so like reasons they would manipulate it. So one of the sources was talking about like swaps traders, like currency swaps. At a bank would ask the employees at their same bank who that were in charge of submitting the rates to provide figures that would be beneficial for the traders, so that they could trade off of it and kind of know in advance, right? or at least kind of a rough idea of like where it might be influenced to, right? And so there's that. Um, it's also kind of, I'm not sure if I'd say like psychological in a way, because you have some like when they would report them, they'd report that they could borrow money at lower interest rates, which kind of implies that they're not as risky because they're like, hey, we should be allowed to take the lower interest rates or whatever. And so that kind of gives an overall market feel that they're better off in times of, say, turmoil or whatever. And as you could tell from the dates that I've talked about earlier, where some of these manipulations were thought to be as early as 2003, and the investigations weren't until like 2010-ish, 20 that decade. There's kind of a big financial event that happened right in the middle of that, to the GFC, right? And so you kind of have a incentive there. And now, to what degree this happened, they didn't particularly say. It's, as you can tell with some publications, if it's not like directly related to the actual subject of the publication, it'll kind of be swept under the rug, and you have to find something else. So there's that. Um, so a couple things that actually came out of this, right? This massive amount of manipulation, right? Allegedly. And so you had, yes, there were some people fired and other things, but you also had a lot of legislation passed, as you typically saw with these financial panics in general. And so one of the, I guess, entities that came out of this was the FCA, the Financial Conduct Authority, which is kind of a centralized government agency with the power to investigate and then regulate financial markets that include LIBOR, right? Um, there's that, and also just with general legislation with the GFC, so like 2007 to 2008, there were multiple pieces of legislation um, on like commercial banks and the financial sector and stuff like that that ended up making um, that decreased the incentive for commercial banks to participate in unsecured lending, right? And so that could be also a possibility why total the volume of these transactions were lower, as we were talking about earlier, going through the actual methodology itself, and not why relatively there was not as many level one submissions, and they had to continuously go down, right? And so, kind of some more recent developments for LIBOR. There's been some play in it, from what I could tell, and so most of them ended. Actually, the Swiss franc and the euro, all tenors stopped at December 3rd, at the end of 2021. So about 6 months ago, 6.5 months ago, as of the time of this video. The US dollar lost the 1 week and the 2 month tenors. So now they're down to five. And then the pound sterling and the Japanese yen lost the overnight, 1 week, 2 month, and 12 months, right? And so they're kind of getting chopped off, so to speak. There's that. And then basically all remaining tenors are supposed to stop on June 30th, 2023, which is 18 months or so from now, kind of giving the market time to either find their own alternative to something similar, or for something else to come up to replace it, right? And so apparently a lot of financial institutions, the market participants that use LIBOR, especially because, as I've said a few times, the amount of the pure dollar amount covered by the LIBOR rate for financial contracts being in the multiple hundreds of trillions of dollars. That's a lot of. It's a big deal just to transfer the underlying rate on which that's kind of priced, I guess you could say. And so to find that alternative to the same extent would be challenging, or there's a lot of nuance to it. And one of the possible alternatives would be SOFR, which is one that I'm currently writing a post on and researching now. And so that should expect that to be out at some point in the next week, week and a half or so, as like I said, I'm traveling for work a lot at this time of year, so we'll see what happens. But I'll try to get that out to you guys as soon as possible. Um, but yeah, I definitely recommend checking out all of these sources. You can get them from the links as well. I did not technically cite this last one, so I didn't put a number with it, but there's a link to that one as well. So, like, I did read that one, but I didn't take any information directly from it. Um, but yeah, that's LIBOR. Definitely something to understand and know about, because even if it does like completely get cut off of the board, like that kind of rate, you need to kind of understand that from like a historical perspective as well. Because it really kind of shows, I guess, the psychology between the banks themselves and kind of them pricing their own counterparty risk in markets. At least that's what comes to mind. So it's definitely interesting. I think so, anyway. But as you can probably tell from the website and the YouTube channel and everything else, I think the stuff is cool. But yeah. Anyways, so that's all I got for you guys on LIBOR. So I hope you guys have a good night, and I'll see you on the next one.